Brad Williams, Frugal Finance, duration, important part of fixed income. And so many CFOs either don't grasp it, don't know about it, or just don't understand how to calculate it, which led to a near banking crisis in the middle of 2023 when Silicon Valley Bank nearly went upside down. Why? Because they had a duration mismatch. Duration is very simple, but if you don't incorporate it into your daily operations, I'll shut up and I'll just explain what duration is all about. Duration measures how long it takes for you to get back the money you invested in a bond through its payments. If you have a bond that lasts for a certain number of years, that's its duration. But for bonds that pay interest regularly, like a coupon bond, the duration is usually less than the total years because you start getting some money back before it ends. Here's how it works. Imagine you invest in a bond and it promises to pay you money over time. The duration is like an average of when you get those payments, with every payment weighted by how much it's worth compared to the total value of the bond. So if you invest $100 in a bond and you get $5 every year, the duration tells you on average how many years it will take for you to get back your 100. When there's a small change in interest rates, it affects the bond's value. Duration helps us understand this relationship. If interest rates go up a bit, the bond's value usually goes down and vice versa. The duration helps us estimate how much the bond's value will change based on how much the interest rates change. For example, if interest rates go up by a tiny bit, let's say 0.1%, the bond's value might decrease by approximately the duration times the change in interest rates. It's a handy tool because it's simple to use and gives us a good idea of how bonds react to changes in interest rates. Let's put it in perspective with an example. Imagine you have a bond with a duration of 2.653 years and a price of 94,213. If interest rates go up by 0.1% or 10 basis points, what would be the new yield? By using the modified duration formula, you can estimate it. After some calculations, you'll find that the new yield would be approximately 12.36%. The duration helps investors understand how sensitive bonds are to changes in interest rates, which is crucial for managing investments effectively. Note, for the purposes of defining duration, all discounting is done at the bond yield rate of interest Y. We do not use a different zero rate for each cash flow as described in R of 1 is equal M exp R of M minus 1. When a small change, noted as a triangle Y, or some call that delta. When a small change in Y in the yield is considered, it is approximate true that, and well, I'm not going to go in and note this specifically, but you can see this formula, and in the end, you're going to have delta B minus B equals D minus delta Y. That means the change in B divided by B is equal to negative D times the change in Y. This is an approximate relationship between percentage changes in bond price and change in its yield. The reason duration has gained such widespread popularity in its user-friendly nature, it's simple to use and understand. Initially proposed by Macaulay back in 1938, duration has become a go-to measure in financial analysis and investment strategies. Let's take a practical example to understand its application. Imagine a 3-year 10% coupon bond with a face value of US $100. It comes with a yield of 12% per annum, compounded continuously. This means that the bond pays out coupon payments of 5% semi-annually. Present value of the bond's cash flow, using the yield as the discount rate, are shown in columns 3. The present value of the first cash flow is 5 exp 12 times 0.5 is equal to negative 4.709. Calculations of duration. Consider a 3-year 10% coupon bond with a face value of 100 and a yield of 12% per annum with continuous compounding. Coupon payments are made semi-annually, $5. The present value of the bond's cash flow using the yield as the discount rate generates negative 4.709. So we have 12%. Here's our semi-annual. This is just the breakdown. I've done this time and time and time again. This right here is just EXP 12.25, half, 3/4, full year. Why? Again, I was doodling. This is my doodling. So here we have this 0.05 divided by 4. We're going to add this up. The present value, D54, which is cash flow, times EXP B54, going to be 12%, times C54, half a year, 4708. We're going to do this repeatedly. We're going to come up with a price of 9421. Here's the weights. We're going to have E54, E, the 4708, divided by E60. So here's our weight in terms of when we're getting our cash back. Here's the weight, 2.65. So we're going to go 0.0 F54 times C54, 265 duration. What we're looking at, a 3-year deal, and the duration is 2.6530. We can take the D54, again, this cash flow, EXP B54 times C54. It looks like I did this twice for some comparison reasons. New yield with 10 basis point increase. Negative B54 plus 0.001. Duration 249. Change 249. New yield price was 93. So we had 94. We have a change in basis points. I guess we're looking at rates that increased from 12 to 12.10. Our pricing is 93969. Using the same information from above, duration and the bond price of 9.2 and 3 and a duration of 2.653. We noted that. The yield expressed with semi-annual compounding is 12.376. What is the new yield with 10 basis point increase using semi-annual interest payments, not continuous compounding? Modified duration, we're going to use this. So now we have 106.2 minus 1. This is the new yield to maturity if interest rates drop 10 basis points. 10% bond maturing in 3 years, compounded semi-annually. We've got this 948421 with a yield of 12.4763. We have face value 110.36, current yield 12.4. Here's just another example. This one shows 1236. If we increased yield by 10 basis points, if yield drops by 10 basis points, we're going to see this price change. We have this 94213 at 12%. We have a price of 93963 if yield increases by 10 basis points. And then we have a price of 93978, 12.4673. Now we have a 94, which makes more sense if interest rates drop. Interest rates drop, price is going to increase. Our coupon's 10%, and we were using 12%. And a current yield of 12%. So I was screwing around. I was doing what I usually do. I'll go off on some crazy friggin' tangent. And anything in yellow is fixed. You're going to input this information. And I don't know where I got this from, but you can see the difference here. We have a 10%. Up here, we were working with 12.36%. Here, we have 12.4673 on a coupon of 10%. Here, we're using that same 10%, and we're using 12%. We're just crunching some numbers, and it doesn't look like anything's even fancy here. This is just like normal pricing, and there's really nothing in terms of zeros or what have you. This just looks like a face value bond, 10%, maturity 3 years, number of periods 6, the current yield. And that would be just some number. We could do that calculation pretty simple. Here's the same thing. So I guess I was just looking at par pricing, and I was looking at this, if we're looking at this continuous compounding, but it doesn't really make sense because we're looking at what coupon did we use? 9/1, purchase date, maturity date. This is XL. All right, just FYI. C87 is the coupon. C90 is the current yield. I was just doing some dribbling around. So you can ignore it if you want, or you can just play around. I haven't introduced this price tool yet. Again, it's XL, returns the price of 1,000 face value of a security that pays periodic interest. I was probably either experimenting with Excel price function, or doing a comparison. I may have been just checking out what the price function does. You're looking at current yield and you're looking at these other yields. Here we're using coupon, and here we're using pricing. We're using current yield here. I mean, we're looking at coupon and then current yield. So I was just playing around, and I wanted to see if I could get the similar pricing, not having to go through all of this, what have you. The reason being, if you look here, we're just using normal compounding, and up here we're using continuous compounding on a semi-annual basis. And pricing, we can use this formula. I don't know if we can do continuous compounding with this price function. That was probably what I was trying to compare. Brad Williams, Frugal Finance. Thanks for watching.